Welcome to this past paper walkthrough. In this video, we'll be working through a sample assessment provided by Edexcel in 2017. We are going to attempt Sonali's question from paper 2. This question has 3 requirements. In the first requirement of this question, we are asked to calculate the equity as at 1 January 2017. This simply means the equity at the beginning of the year, also known as opening equity or opening capital. To calculate opening equity, we use a very important accounting rule. Equity equals total assets minus total liabilities. So the first step is to list all the assets the business had on 1 January 2017. From the question, the assets are: bank, 1,250. Fixtures and fittings at cost, 50,000. Less accumulated depreciation, 5,000. Inventory, 27,500. Trade receivables, 42,500. Remember, for non-current assets, we always deduct accumulated depreciation from the cost to get the carrying value. Now we add all the assets together and deduct the accumulated depreciation. This gives us total assets of 116,250. Next, we calculate the total liabilities as at 1 January 2017. From the question, the liabilities are: other payables, general expenses, 1,350. Trade payables, 37,450. There are no other liabilities mentioned, so we add these together to get total liabilities of 38,800. Now we apply the formula. Equity equals total assets minus total liabilities. 116,250 minus 38,800 equals 77,450. So, the opening equity as at 1 January 2017 is 77,450. Remember, opening equity and opening capital mean the same thing. It's just the owner's investment in the business at the start of the period. Now let's move on to the next requirement, which is to prepare the trade receivables control account. Don't worry, this is very similar to the control accounts you've already done in paper 1, so we'll follow the same steps. We start with the opening balance, which is 42,500. This represents what customers already owe at the beginning of the year, so it goes on the debit side of the trade receivables control account. Next, look at the bank summary. This is basically the cash book. From here, we can see that Sonali has received 142,000 from her customers. Since customers have paid us, trade receivables decrease, so this amount goes on the credit side as cash book. After that, the question shows sales of 145,000. We're told that all sales are credit sales, so this amount increases trade receivables. That's why we record it on the debit side of the control account. The question also mentions irrecoverable debts of 3,050. This means some customers will not pay at all, so we write this amount off. Writing off receivables reduces what customers owe, so it is recorded on the credit side. That's all the information we need, so now we can balance the account. When we total both sides, the debit side is higher, so we add it up to 187,500. We write this total on the credit side, and the difference on the debit side is 42,450. This figure is the closing balance of trade receivables. Finally, don't forget to include the correct dates, using the same format you practiced in paper 1. Now, we move on to the final part of the question, preparing the statement of financial position as of 31st December 2017. Since the date is the end of the year, we focus on the closing balances. The statement starts with assets, beginning with non-current assets. In this question, the only non-current asset is fixtures and fittings. Take the cost of the fixtures and fittings on 31st December, which is 50,000, and then deduct the accumulated depreciation of 10,000. This gives you a carrying value of 40,000, which is the value we report in the statement of financial position. Next, we move on to the current assets. In this question, the main current asset we look at is the bank balance. However, we don't have the closing balance directly, so we need to calculate it using a bank account in our workings. We start with the opening bank balance, which is $1,250. All receipts go on the debit side. This includes cash received from trade receivables. There's a small mistake here where I wrote the closing balance of trade receivables instead of the actual cash received. Don't worry, we'll correct this in our workings. All payments go on the credit side. These include trade payables of $92,750, drawings of $18,700, and general expenses of $34,500. Next, we check which side is higher. In this case, the credit side is higher, so we put the total on both sides and calculate the difference on the lower side. The difference comes on the credit side, which tells us that the bank has a credit balance, meaning it is actually a bank overdraft, a current liability. Therefore, we do not include it as a current asset. Now for other current assets. We start with inventory, which is $33,950, and trade receivables, which we calculated from the control account as $42,450. There are no other current assets in this question. Adding these together gives $76,400 as the total current assets. Finally, we add the non-current assets of $40,000 to the current assets of $76,400 to get the total assets of $116,400. Now that we've calculated total assets, let's move on to the equity and liabilities section. We'll start with equity. First, we write down the opening equity, which we calculated earlier as $77,450. Next, we need the profit for the year. The question doesn't give it directly, but it tells us that profit is 15% of revenue. So we set up the equation, profit divided by revenue times 100 equals 15. Rearranging that, profit equals 15 times 145,000 divided by 100, which gives us 21,750. We write 21,750 as the profit for the year. Then we include drawings of 18,700. Finally, we calculate the closing equity by taking opening equity, adding profit, and subtracting drawings. So, 77,450 plus 21,750 minus 18,700 gives us 80,500. That's our closing equity, which we include in the statement of financial position. After we've finished the equity section, let's move on to the liability section. Liabilities usually start with non-current liabilities, but in this question, there aren't any. So we can go straight to current liabilities. The first current liability is trade payables, which is $32,400. Another liability we have is other payables for general expenses, which is $800, so we'll write that beside other payables in the statement. Next, remember our earlier calculation for the bank. We realized there's actually a credit balance, which means we have a bank overdraft. But before we add this to the statement, we need to fix the error we spotted earlier. By mistake, we wrote the trade receivable closing balance as $42,450. The correct figure should be the cash received from trade receivables, which is $142,000. After making this adjustment, we find that the bank has a credit balance of $2,700. So, our bank overdraft is $2,700. Now, we add up all the current liabilities, trade payables, other payables, and the bank overdraft, to get a total of $35,900. Finally, we add the total liabilities, $35,900, to the closing equity, which is $80,500. This gives us $116,400. And there you have it, total assets of $116,400 match the total of equity plus liabilities, also $116,400. This is exactly what we want in every statement of financial position. Your assets should always equal your equity and liabilities. Always check this when preparing or reviewing financial statements. If you found this video helpful, don't forget to like, share, and subscribe for more accounting tips and past paper walkthroughs.